Welcome to Deloitte's Debrief Tax webcast series in Asia Pacific. Our webcast today is from our corporate income tax series and is titled Doing Business in India from a Tax and Regulatory Perspective. My name is Rohinton Sidhwa and I'm a tax partner based in Deloitte, India. I have the pleasure of hosting today's webcast. Along with me, I have two speakers, Neha Agarwal and Hema Loya. Neha and Hema are both tax partners and they are based in Deloitte, India. You may access our bios on the left-hand side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First of all users are on a listen-only mode, and if you have any content-related questions, you can submit them at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can either maximize or minimize their boxes at your convenience during the webcast. You can also explore the icons at the bottom of the screen, and if you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on their screens. Thirdly, if you require an attendance record for this event, you will receive an automated email with CPE credits after watching for 50 minutes. With that, let me get to the overview of today's topics. Essentially, we have about 5 topics curated in today's update, all of which are very relevant and timely. The first one we'll be talking about will be the angel tax provisions, which actually impact the way you contribute capital to Indian companies. Next, we'll be talking about the production-linked and manufacturing incentives that are recently making waves and is the future of tax incentives in India. Then we'll also talk about software and the ever-changing debate around royalty and the new equalization levy. We'll spend some time also speaking about the new form for claiming treaty benefits, which has become a very topical issue from many of our clients. We will round up then with some regulatory developments. With that, let me move on to the next slide and talk to you about some of the things that are happening in the Indian economy. We are now the 5th largest economy in the world, estimated at $3.5 trillion, strong FDI flows, and a strong rate of growth that expected to continue for the next 3 years. In addition, there's also a strong base of foreign currency reserves that stands to the asset of the government. The biggest thing that's probably going for India at this point of time is the fact that we are harvesting a population dividend. We are slated to have the second largest working population in the world of almost 500 million people, many with a median age of 29 years. So a significant upside that's expected for our economy. Moving on to some of the tax aspects, the tax to GDP ratio is approximately 11.7% and it's climbing. And many of you who've dealt with India know that for some time now, all taxes are actually filed and paid electronically. The year-on-year growth in GST collections has been around 12% and direct taxes at 10.5%. But even at this stage, only 6% of individuals actually pay income tax, and that's where perhaps our population dividend will actually return a much higher tax dividend for the government. These are interesting times for India in terms of making waves. Currently, India is now the president of the G20, and it's a critical time because the Pillar 2 and Pillar 1 mandates are being debated at this point of time. So people in tax are obviously taking notice. In addition to that, our speakers will also talk about Make in India initiatives as well as the Indian payment stack initiatives that the government has made. And we'll also try and find some time to talk about free trade agreements and discuss about some of the trade preferences that India gives to other countries. With that, let me hand it over to Hema to briefly talk about the changes that have been made on capital contributions that are to be made to companies in India.
Thank you, Rohinton. The most common funding options for investments are by way of equity or debt. Depending on business objectives, there can also be a combination of compulsorily convertible or optionally convertible preference shares or debentures. In respect of investments made by a non-resident investors in India, exchange control regulations are applicable. In respect of equity investments and compulsorily convertible instruments, FDI regulations, which also deals with sectoral cap, pricing guidelines, etc., are applicable. In respect of debt, there are also conditions which also include end-use restrictions, minimum holding period, rate of interest, etc. In respect of investments made by way of equity shares as an anti-abuse measure to target generation and circulation of unaccounted money by way of a share premium, there are provisions under the domestic tax law wherein if on issue of share capital by a closely held company there is a premium, then the amount paid in excess of the fair market value as defined to the closely held Indian company for issue of shares is taxable in hands of the Indian company. The said provisions are also commonly referred to as angel tax provisions, and they were applicable only in respect of investments by a resident shareholder until 31 March 2023. So, what changed? Now, an amendment in said provisions were made in Budget 2023, wherein conditions relating to residency has been removed, and therefore, effective from 1st April 2023, investments by non-resident investors are also covered under said provisions. The said amendment raised many concerns and questions for investments by non-residents. Example, applicability of the transfer pricing provisions, are there any exclusions, how provisions will be reconciled with the other regulations, etc. Let's start on applicability of the transfer pricing provisions on issue of share capital. Under the provision of tax law, the basic condition for applicability of a transfer pricing provision is there should be presence of income from any international transaction. The term income has been defined under the Act to include the excess amount received on issue of shares. So, in other words, angel tax is defined in income. The question for consideration is therefore whether provision of transfer pricing are applicable on issue of shares. One view is if issue of share is a capital transaction, an angel tax provision are code in itself, which also defines fair market value. Therefore, provision of transfer pricing provision may not be applicable. However, another view is excess amount received is now considered as income, and there is also specific mention in Form 3CEB for reporting issue of shares, and therefore whether transfer pricing provisions are applicable. The non-resident investors investing in their associated enterprise may therefore need to assess the same. Let's also look at the impact of angel taxation by way of an example. Next slide, please. In this example, let's assume the issue price is 120, whereas the face value and a fair market value is INR 10. Now, as could be observed in the table, until 31 March 2023, if consideration were received at 120 for a share which is face value and a fair market value is 10, there was no consequences in hands of the foreign entity. However, With this amendment, from 1st April, the difference between consideration and the fair market value, which is 110 is this example, will be taxable in hands of the foreign in the Indian company, and it will bear the tax liability of 28, assuming the tax rate is 25.17%. Let's also now look at another question. Are there any exclusions? Now, considering that these provisions are anti-avoidance measures, several representations were made for excluding certain category of investments. Now, under provision of Act, there's a right available to the central government to notify certain class of investors to whom these provisions will not be applicable. After considering various representations, in fact that the provisions are for prevention of unaccounted money, to mitigate hardship, a circular has been issued on 24th May 2023, excluding certain class of investors from the provisions of angel taxation. Next slide, please. Now, the categories that are specified includes government and government-related investments. So if there's any investments by a government-controlled companies or where directly or indirectly government owns more than 70%, 75%, those category of investors are excluded. Second category is banks or entities involved in insurance business, where they are also applicable to the said regulations in their resident country. The third category is investments from a specific country, and if the investor is a category 1 FPI registered with SEBI, second, endowment funds associated with a university, hospitals, or charities, third, pension funds, fourth, broad-based pooled investments vehicle or fund where number of investors are more than 50 and such fund is not a hedge funds. Important point to note here is if investments by the last category of investors come from countries that are not notified, for example, if the investments are coming from countries like Singapore, Mauritius, Netherlands, etc., then the exemption will not be available. Also, no exemption has been provided in respect of other non-resident investors. Next slide, please. Now, as discussed earlier, in respect of investments by non-resident in an Indian company, the provisions of exchange control are also applicable. Now, as per exchange control regulation, there are pricing guidelines applicable when a non-resident investor invests into a shares of an Indian company. And as per said guidelines, the fair market value the value at which non-resident investor can invest will have to be at fair market value or above fair market value. Therefore, fair market value is a minimum price under exchange control regulation. Whereas under the tax law, if investments are made above fair market value, then it will be taxable in hands of the Indian company. Therefore, to reconcile both the provision, the only option that may be available will be to invest at exactly fair market value. However, there is a difference in definition of a fair market value under exchange control regulations and under the Act. Under the exchange control regulation, it is as per any internationally accepted pricing methodology, whereas under the tax law, there are only two methods permissible, that is discounted cash flow method and net asset value method. There is also disconnect in the valuation date as defined under the Act and under exchange control regulations. Under exchange control regulation, a valuation report issued within 90 days of issue of shares is okay, whereas under the provision of Act, it's the date on which the consideration is received. Now, considering the differences, various representations were made to align the tax provisions with the exchange control regulations. Based on the same, a draft notification was issued in May 2023, which was also available for public suggestions or comments until 5th June 2023. Now, some of the key provisions proposed in the draft circular relates to valuation methodology. Under the existing provisions, only two methods are prescribed. The draft rule proposed to include five additional methods of valuation, and these are in addition to the above two methods. Further, to reconcile the valuation date, it's also proposed that if valuation report by merchant banker is not more than 90 days prior to issue of shares, then at option of taxpayer, said date may be considered as valuation date. Lastly, draft rules also provide for safe harbor threshold of 10%. Now, currently, if there's any difference in the consideration received in a fair market value, say even by 0.5%, then excess is taxable in the hands of the Indian company. However, with the safe harbor proposal, if the difference in consideration received and a fair market value is up to 10%, then no adjustment should be made in hands of the Indian company. The said rules will be applicable from the date to be notified. The proposed rule should therefore help reconcile some of the key concerns of the non resident investors. With this, I hand it over back to Rohinton.
Thanks very much, Hema, for that detailed explanation. So you surely would like to be part of those 21 countries and not be left out. In any case, let's go straight into our first polling question for the audience. The question is, do you envisage injecting fresh capital into your existing operations in India during this financial year? And the options are yes, no, maybe, don't know, not applicable. And while those graphs keep moving along, let me ask a question to Neha. Neha, as you know, when fresh shares are issued in India, there's also a stamp duty payable. Can you inform the audience how that works?
So, for a closely held company, the stamp duty is levied at 0.005%. So, if the shares are issued and the consideration is equivalent to the fair market value, then there is no dispute. But in case there is a difference in the valuation, then effectively whatever is a higher amount, the stamp duty is leviable on that amount. In addition to that, in case there is a change or increase in the authorized capital, there is a stamp duty which is levied of approximately 0.002% on the incremental share capital.
Thanks very much, Neha, for that. And as we see those graphs moving along, a lot of people are saying that share capital injections as of now is not, don't know, or not applicable. Which is probably a good thing until the rules become very, very clear. With that, let me move on to the next section of our presentation, where we will be talking about supply chains in India and the incentives that are available for manufacturing in India. So over to you, Neha, for that.
Sure. Thanks, Renton. And Make in India has been an initiative of Government of India over last 9 years. So this Make in India was first initiated back in 2014, wherein the objective was to push innovation and manufacturing in India. And 27 sectors were identified as a priority sectors, wherein investment promotion and ease of doing business exercises was done over the last couple of years. Back in 2020, the government came out with a focus scheme of Make in India, wherein both from a cash incentive perspective, government came out with a scheme called Production Linked Incentive Scheme. This scheme was focused on 14 sectors with an outlay of approximately $26 billion. And these sectors included the priority sectors electronics, automobile, food processing, pharmaceutical, solar, electric vehicles, white goods, textiles, etc. Now, one important piece that the objective of this was to push manufacturing in the country and link it to the global supply chain. At the same time, the government was also very cognizant of the fact that it needs to be WTO compliant. And for that purposes, it ensured that this was a cash scheme which was linked to the incremental sales and it was not linked directly to exports. In addition to that, there were no obligations of foreign exchange earnings or minimum operations period. So, as and when the company was operating, it could avail the incentives. Now, this in addition to that, in budget of this year in February 2023, another $1 billion approximately amount was again introduced for the purposes of enhancing this production-linked incentive scheme. And one of the sector which has come out with the scheme is the IT hardware. So it's IT hardware PLI 2.0, which has a similar objectives. And the products covered here are laptops, tablets, personal computers, servers, and USF devices. What it covers is both the global manufacturers and domestic manufacturers. Domestic manufacturers are the ones which are owned and controlled by resident Indian citizens. This scheme also factors into account the new category, which is a hybrid. So if the window of global companies and the domestic companies is completed, then one can also look at the hybrid category. The incentives are ranging, the approximate incentive that one can look at is approximately 5%. And there are additional incentives which have been provided for the components which are either assembled in India or procured from India. In addition to that, this scheme has a total outlay of approximately $2 billion. And the capping is based on the category of applicant which is being chosen. There is also a flexibility which is provided of choosing the start date. So one can choose 1st April 2024 or 1st April 2025 as a commencement date. How the eligibility is calculated is again based on the investment and a turnover criteria. And again, based on which category you fall in, the global company, hybrid company, or a domestic company. So the minimum investment threshold is of approximately $61 million for the global company. For domestic companies, they have been incentivized to keep it $2.4 million. Similarly, the thresholds for global companies is approximately $1.21 billion, and the domestic company is approximately $36 million. There have been, as I said, that there are incentives which are provided for the domestic value addition, which is done for components. But as of now, it does not have a mandatory value addition requirement, which was there in the auto PLI scheme. In addition to this, one can also look at the state incentives policies which are being prescribed. This is the first policy which has come after the PLI 2.0 announcement. And we do expect that there'll be another 5-6 categories in which the PLIs will be announced in footwear, leather, bicycles, toys, and other categories. If we can move to the next slide. So this is another initiative of Government of India of public procurement. This is any supplies which are made to the government institutions or public sector units which are funded by the government, central government. So there is a mandatory local content requirement. So any suppliers who have government as a customer are subject to the public procurement order, wherein the minimum local content requirement has been prescribed ranging from 20 to 50%. Now, what does this mean? This means that today the government approximately floats 101,000 tenders per month. And the value is actually ranging from 21 lakh dollars, which is approximately $250 billion dollars. So it's a very big number. Now, how does it impact? Any procurement which is done for a value of approximately $25 million, this provisions become applicable. There are 3 categories of suppliers which have been prescribed. Class 1 supplier is the one which does the minimum value addition of 50% or more in the country. So if you qualify as a class 1 supplier, then you have an eligibility of matching the L1 price. L1 is basically the lowest price. Or if the project can be split, then the L1, you can share with him the 50% of the portion. In case the value addition requirement is 20 to 50%, then you qualify as class 2 supplier. And in such a case, you will be eligible to supply to the government in case there is no class 1 or local supplier. And the third category, which is where the minimum local content is less than 20%, here the company will be able to supply if the tender value is more than 200 crores and it is not falling under the minimum value of 200 crores. Now, these requirements came in back in 2020, but there is a lot of enforcement that has started happening on ensuring that the policies are implemented across different ministries. Now, what has recently been done is that all the ministries have been making sure that this comes in as part of the tender requirements across different sectors and products. And 18 ministries have come out with their own public procurement orders, wherein there is a prescriptive requirements for the specific products on how they will need to meet the local content requirement. Additional piece that has been also made sure is that investments of suppliers, if they are from countries which are sharing land borders with the country, they require a prior approval from Ministry of Commerce. And the government has been sensitive on some of the key sectors like infrastructure, ports, etc. And any involvement, and there is a mandatory requirement of transferring the technology. So these are some of the trends which we are seeing recently. In terms of decision making, what we have seen across industries, there is a push where the priority sectors suppliers for the customers are actually the government or government institutions. There is a push for looking at relooking at their value chain and therefore looking for alternatives for India investments and manufacturings. And to that extent, either a partnership with local OEMs or setting up the greenfield manufacturing facilities or relooking at their supply chain has become very, very relevant. In the meantime, some industry has also been pushing for a timely exemption so that the setup of manufacturing could be done. So these are some of the trends that we are seeing on the procurement stage. Next slide, please. What we've also seen is that, in addition to what the cash incentive scheme has been providing and the mandatory requirement of local content, so it's a carrot and stick approach that government has been adopting. There is also facilitation that government has been making sure for, allowing manufacturing in the country and pushing investments in the country. And for that purposes, a lot of easing measures have been taken from a compliance standpoint. Around 1,500 archaic laws have been repealed and 32,000 compliances have been reduced. In addition to that, around 3,500 provisions have been decriminalized and simplified. In addition to that, the government endeavor is to use faceless approval processes and making sure that the approvals are on timely basis. So a national single window system has been introduced, wherein around 600 plus central government approvals and 4,000 state government approvals have been integrated across 19 states and UTs. And over a period of last 1 year, we have seen that around 75,000 approvals have been granted through a national window system. The foreign trade policy has been recently introduced, wherein earlier there was a 5 year foreign trade policy which had a sunset. Now, the new foreign trade policy does not have a sunset clause, but it will keep on amending on a need basis. What it comes out with the newer kind of amendments is introduction of e-commerce export, and there's a lot of initiative and incentives that they have provided there, wherein the infrastructure support like export hubs and using the foreign post offices have been introduced to facilitate exporters do a warehousing in the exporting countries. In addition to that, merchanting trade, which was restricted for all restricted products, wherein high sea seals could not be done. Now that has been permitted, except for certain category of products like SCOMET, which are falling under SCOMET or sites. From an EPCG scheme perspective, again, textile and dairy sector, they have been included under the exemption limit. And average export obligation requirement has also been extended to battery EVs and green hydrogen. For advanced authorizations, apparels have been included wherein they have been put in under the self-declaration, and self-ratification scheme for input-output norms have been extended to the two-star exporters. An important piece that has come out is actually a long-standing demand of amnesty scheme for advance authorization, and this has been now put in place and formalized. With respect to the remission scheme, there has been a rebate, and this has been extended to chemical, pharmaceuticals, and steel sector, considering that these would be the priority on account of the global situations. From an infrastructure support perspective as well, the government is really pushing for ensuring that the manufacturing units, when they are set up, there is a seamless infrastructure which is provided by the government. And therefore, the digitization of all public projects have been made sure with introduction of Gati Shakti scheme. In that context, 16 ministries have been aligned, which are railways, highways, telecom, shipping, steel, etc. And all the projects have been integrated. Ports have aligned around 101 projects of USD 7.6 billion. Similarly, power transmission of 454,000 circuit kilometers have been added to this. Telecom sector, we have seen that around 2 million telecom towers have been integrated. So we see that there is a lot of digitization happening to make sure that the infrastructure is made in a right way and there is a right tracking to this. On India's tax story, again, with the four layers being present on paperless, presentless, and cashless scheme, the consent-based layer scheme has been introduced across various initiatives of the government, which is UPI, which is payment solutions, DigiLockers for and Aadhaar eKYC, CoWIN app we have seen recently. So these are some of the initiatives that we have seen from a government of India point of view, which has enabled ease of doing business, simplifying compliances, and ensuring there is an incentive for people setting up manufacturing facility in India. Over to you, Renton. Thank you.
Thanks, Neha, for that summary. And it's great to hear that there's a lot of cutting of red tape that's going on. Let's now move into our next section, and I'll get Hima to kind of talk about a topic that has kind of seesawed in India, and that is the taxation of software. Over to you, Hima.
Thanks, Rohinton. Well, the litigation around payment of computer software has been ongoing for almost 2 decades. The said issue was resolved for certain categories by Supreme Court decision in case of Engineering Analysis Center of Excellence Private Limited. Now, in said ruling, in respect of distribution arrangements, Supreme Court has noted that distributor is only granted a non-exclusive, non-transferable license to resell computer software. It is expressly stated that no copyright is transferred either to the distributor or to the ultimate end user. No right has been granted to sublicense or transfer, nor is there any right to reverse engineer, modify, reproduce in any manner otherwise than permitted by the license to the end user. What is therefore paid for by way of a consideration by the distributor to the non resident manufacturer or seller is a price of a copy of a computer program as a goods. The distributor margin is therefore that of an intermediary who resells the same product to end user. Considering the same, Supreme Court held that distribution of copyrighted computer software will not constitute an interest in a copyright and therefore should not be regarded as being in the nature of royalty. Now, similarly, in respect of end user agreements, Supreme Court noted that the end user can only use the computer software by installing it in the computer hardware and cannot reproduce the same for sale or transfer. That is, no act contrary to the terms imposed by end user license agreement. The license granted via end user license agreement is not a license in terms of a copyright, but merely a license that imposes certain restrictions for use of computer software. Now, based on the same, the Supreme Court held that the amount paid by resident Indian end users to the non-resident computer software manufacturer or supplier, again, do not fall within the definition of royalty and therefore should not be subjected to tax in India. While the legal position on the payment of computer software is now clear, the tax department often audits and challenges the treatment at the time of audit proceedings. Also, it's been observed that in cases where there are distribution arrangements, the tax authorities are also evaluating the relationships in more detail. That is, are they agency-based relationship or a principal to principal? It's therefore important for the companies to review the computer software receipts or enterprise license agreements with the distributors or the end users to arrive at the tax position in respect of software receipts. Next slide. Now, in as regards cases where it's not a royalty or a fees for technical services, then the applicability of equalization levy is required to be analyzed. Now, equalization levy is applicable in respect of provision or online provision of goods by the e-commerce or online provision of services by the e-commerce operator. Both the definition of online and an e-commerce operator are very broad, and therefore, if there is any leg of a transaction that's online, there is a possibility that the equalization levy provision may be applicable. Also, equalization levy is not under domestic tax law provision. It's by virtue of a finance act, and no treaty benefit is applicable. Equalization levy is applicable at 2% on a gross consideration, and it is the responsibility of a non-resident recipient to pay the same. It's applicable if consideration exceeds 2,50,000 from a person resident in India, and in respect of sale of data collected from a person resident in India, it also includes receipts from non-resident. There's a likelihood that the equalization levy will be withdrawn once BEPS Pillar 1 is implemented. Therefore, if payments are not in nature of royalty or FTS and are not effectively connected to a permanent establishment of a non-resident in India, then the provision of equalization levy applicability is required to be analyzed. It would therefore be important to assess the payments relating to licenses, maybe one time or a perpetual, subscription models, intergroup transactions, cross charge between the group companies, etc., whether they are covered under the definition of equalization levy or not. Let's look at the next slide and assess if the transaction is indeed in the nature of a royalty or a fees for technical services and tax is required to be withheld as applicable, then what change has happened? Now, until 31 March 2023, royalty or fees for technical services received by non-resident not connected to permanent establishment were subject to tax under domestic tax law at 10% plus applicable surcharge and cess. The said rate was equal to or lower from the tax treaties in many cases. However, effective from 1st April 2023, it's now proposed to tax the royalties and fees for technical services under domestic tax law at 20% on a gross basis plus applicable surcharge and cess. So what's the impact of this amendment? Based on the same, as the rate of withholding tax under the Act is now higher than most of the tax treaties, the taxpayer will now have to seek relief under the tax treaty. Now, however, in order to claim benefit of the tax treaty, there are certain regulations that are required to be complied with. First and foremost, in order to claim benefit of a tax treaty, a tax residency certificate issued by the resident country is required. Second, there are certain details that are required to be mentioned in a tax residency certificate. If said details are not specified in the tax residency certificate, then a declaration in Form 10F is required. Also, the non-resident recipients are required to ensure whether they are eligible to avail the benefit of a tax treaty, considering the conditions specified in the tax treaty. For example, are they beneficial owner of the royalties or fees for technical services? Is there a multilateral instrument applicable, and therefore do they satisfy the conditions relating to principal purpose test or the anti-avoidance rules? If the tax treaty benefit is not available, then the taxes will be withheld under domestic law at 20% plus applicable surcharge and cess. As a next step, the non resident recipient of royalty or fees for technical services will therefore need to assess the eligibility to claim the treaty benefit. Second, uh, the payer of the royalty or fees for technical services also at times requires certain additional documentation. For example, a no permanent establishment declaration. The said requirement may also need to be assessed and addressed as applicable. Lastly, under provision of domestic tax law, there's an exemption from filing of a tax return if the taxes are withheld as per provision of domestic tax law. If the taxes are now withheld under the tax treaty rate as applicable, the non-resident recipient of royalties or FTS will also have to evaluate the compliance requirement such as obtaining FAN, obtaining permanent account number, filing of income tax return, transfer pricing report if it's with associated enterprises, etc. Uh, Now let me on the next slide, please. On the next slide, let me also talk on another requirement to avail the benefit of the tax treaty. Now, as we discussed, under provision of the domestic tax law, in order to claim benefit of a tax treaty, the tax residency certificate and Form 10F, if the details are not provided in TRC, then the Form 10F is required to be filed. The tax authorities, by the notification in July 2022, mandated a list of forms to be filed electronically. One of the forms prescribed in said notification was Form 10F. Accordingly, Form 10F is now required to be filed online. However, to mitigate hardships, the tax department has issued a circular and exempted non resident taxpayers that are not required to obtain PAN from a mandatory filing electronically of the Form 10F until 30th September 2023. So there's an option with a non-resident that they can continue to file Form 10F as they did earlier until 30th September 2023. However, post that, they will have to file Form 10F electronically. Let's also now evaluate in the next slide what could be some of the implications if Form 10F is not submitted online. Now, if you already have a PAN or you are required to obtain a PAN, then there's a requirement that you file Form 10F online. And in order to file Form 10F online, one mandatory requirement is to have a PAN. If PAN is applicable and Form 10F is not filed online, then based on provisions of the Act, read with the rules, there's a possibility that the tax authorities may allege that Form 10F filed or given in a manual form is not a valid form and consequently may deny the tax treaty benefits. Now, also under the provision of a tax law, payer of any income to a non-resident has a responsibility to ensure the correct documentation and based on that assess the applicable withholding tax. Therefore, in absence of a valid Form 10F, there's a possibility that the payer may not grant the treaty benefit and withhold taxes at a higher rate as applicable under provision of domestic tax law. Also, in some cases, let's say there are associated enterprises in India, an Indian company makes a payment to your non resident A. without verifying the correctness of the documentation, then there's a possibility that the tax authorities may allege that taxes are not withheld appropriately and may face with the consequences of not withholding appropriate tax, which could also include some part of denial of deduction. It's therefore advisable to file Form 10F as early as you receive your tax residency certificate, and or before any payer has to remit any payment to you. But in any case, before on or before filing of the tax return. Lastly, let's also assess a situation where non-resident has a business income in India. Now, this business income could be due to, say, you have a business connection, or you have a significant economic presence in India, or possibly there's any income that accrue or arises in India. Now, in this situation, an exemption under tax treaty is claimed. That is, there is no permanent establishment in India, and therefore business income is not taxable in India. Now, in this case, if treaty benefit is denied because of a small compliance requirement, then the business income could also be taxable in India. Therefore, it's important to assess the requirement of filing of a Form 10F online and comply with the same. A small compliance, however, non filing can result in significant implications or litigation. Now, with that, I hand it over back to Rohinton.
Thanks, Hema, for that explanation. And many countries do require you to make a filing for claiming treaty benefits, but most countries don't require to ask you to register for taxes as well. In any case, let's move on to the next question that we have for the audience. And the question is, do you have foreign entities that have transactions in India but no PAN registrations? And the options are: we do not find the need to register as they are not taxable in India. We are uncertain about the need to register. We have already registered, nothing further to be done, and don't know, not applicable. So while the audience is figuring out their answers to that question, Hema, I have a question for you. Do you often see your clients struggle with the need to register for treaty benefits? And what are the top reasons that you come across in your discussions with your clients?
Well, I will say the top two reasons could be a combination of either PAN is not obtained because of some apprehension that it will increase the visibility, or possibly not fully aware of the requirement. So it could be possible combination of the same.
Right. With that, I'm seeing the results of the poll come up on the screen, and a sizable portion of the audience seem to say don't know, not applicable. And that's probably because the 10F is relatively new, and many people are probably uncertain about what exactly is the filing to be done. With that, we now move into the last section of our presentation, which is a regulatory update by Neha on various aspects. Neha, over to you.
Yeah. In this section, what we are covering is that as businesses are evolving, the regulations are also evolving. And we are seeing that a lot of changes are made in light with how the technology is being introduced across sectors. So the obligations with respect to the compliances, reportings, and self-regulations codes have been introduced. The first one has been the intermediary rules. This is a rule which comes out of the Information Technology Act. And any facilitator, whether it is a marketplace or a service provider, which is enabling businesses between two entities, is subject to the intermediaries requirement. What are the requirements? The requirements are that in case there is a content which is required to be removed by the law enforcement agencies, that needs to be removed within a period of 36 hours. Any information which is required to be submitted to the authorities needs to be submitted within a period of 72 hours. The grievances need to be acknowledged within a period of 24 hours, and the addressal of those grievances should be done within a period of 15 days. Similarly, for the news publishers of digital media, there have been a self-regulatory authority that has been onboarded by Ministry of Information and Broadcasting, which has come out with the self-regulatory requirements. Now, these are largely applicable to significant social media intermediaries who have a user base of more than 500,000. And what obligations it also places is that there is a requirement for having a resident employee and physical office in India. The grievance addressal officer needs to be there, whose name needs to be published on the website. And with this, what we are seeing is that foreign companies who have user bases in India and who are meeting these threshold requirements have set up, irrespective of whether they had a subsidiary company in India, but they are required to have an office in India. So we've seen a lot of license offices set up on account of this requirement. What has been extended very recently is that this applicability, there have been specific provisions for online gaming intermediaries which are dealing with real money games. What it requires, again, is similar to what has happened to the digital media, wherein the self-regulatory authority has been created, and which will be onboarded by Ministry of Electronics and Information Technology. And there is a similar requirement of having the resident employee's physical office and the grievance addressal officer. There is a specific prohibition that has been made on wagering, and therefore the long-standing debate of game of skill versus game of chance still remains. But I think with the self-regulatory authority onboarding the games, and the games need to be licensed by the self-regulatory authorities, there will be a lot of filtering in terms of the content and making sure that the industry also sees some stability here. Another amendment that we've seen recently is the Competition Amendment Bill, which was passed by the Parliament in April 2023, wherein the computation mechanism for deal value, in addition to the turnover and the asset criteria, the deal value has been prescribed of around $240 million, which is 2,000 crores in Indian rupees. Similarly, the control definition has been extended to include material influence and through the management affairs and the strategy of the company, wherein apart from the shareholders agreement and documentation, this has been extended through the affairs of the relevant people. A long-standing demand of IPR exemption, right now it's not considered, but what has recently also been added is a hub and spoke arrangement, which has been included, wherein a lot of companies, because of the integration of technology across different sectors, are coming together. And therefore, there was a long standing demand to include the hub and spoke model also within the ambit of Competition Act. From a simplification of compliance perspective, the settlement and commissioning mechanism has been added, and the reduction in terms of overall completion of the assessment process has been reduced from 210 days to 150 days. The penalty provisions have also been aligned with the new requirements. There is also an upcoming Digital Competition Act that we expect very shortly. Here again, this is largely to cover digital companies, and startups have been really pushing this to make sure that there is an alignment from a ecosystem perspective, and therefore we expect that there may be ex ante provisions that may be introduced rather than an ex post facto enforcements. And some of the issues that have been laid in the digital space on deep discounting, monopolization, and anti-competitive practices should be included within the spheres of this provisions. Again, on the satellite piece, the satellite policy has been introduced recently. So earlier, only ISRO, from India satellite perspective, was permitted to host the satellites, and now the private sectors has been allowed to enter the space, wherein they can do a building of satellites, rockets, and launching of vehicles. Also, allied services like data collection and dissemination could be done. There are detailed guidelines that will be provided by a specific authority called InSpace, and New Space India Private Limited will basically be monetizing on the expenditure that will be done in terms of generation of data and information. So the technology and platform will be open for private use as well. We expect the detailed framework to be released shortly on this. Uh, on the financial services space as well, on the next slide, we have seen that with again the technology introduction, both from an outsourcing perspective on banks and insurance companies, there have been detailed guidelines that have been introduced by the regulators, which is insurance regulator as well as Reserve Bank of India, wherein one specific important highlight that has been made is on making sure that the breaches are notified within a period of 6 hours. There have been a detailed process that guidelines that have been prescribed on risk-based approach for onboarding the contractors. And an important change, again, from an RBI standpoint, has been to allow group entities also to act as a service provider, which was specifically restricted earlier. So, till the time the transactions are on arm's length basis, the group companies can be onboarded. Joint audit has been again a demand from an industry wherein if there is one service provider which is providing services to multiple regulated entities, banks, financial institutions, then in that case, one single audit could be done. And regular audits by the internal or the external auditors have been prescribed. Another important development that we've seen is on the data classification. So earlier, the MHA guidelines were being followed for using the data classification provisions, but insurance regulator has come out with the four classification within which the insurance companies can do the classification and then come out with the outsourcing requirements in their SLAs. So largely what we see is that the regulators are aligning with the new technology evolvement and considering the customers and the personal data in mind, these guidelines have been prescribed. On the technology sector, again, we are seeing that Digital India Act is expected shortly, which will largely subsume the Information Technology Act, considering the new technologies that are being evolving. Similarly, the Data Privacy Bill, again, after the committee's recommendation, we do expect that DPDP will be again placed in the Parliament in the monsoon session or in the winter session. On the telecom bill, which is again an amendment to the Telegraph Act of 1867, this again will factor into account the newer technologies of OTT communications. So the draft was released for public consultation, and now we do see that there will be some action that will be expected shortly. On the adjudication side, again, we are seeing that from a regulator perspective, cross-border transactions are being closely looked at. While the processes have been simplified, but if there are any breaches on account of outbound, inbound investments, or even the trade payables, we are seeing that there are huge penalties that the Reserve Bank of India is levying. In addition to that, there are enforcement authorities which have picked up cases and attached assets and created investigations across gaming sector, across investments which have made from land bordering countries, and they have not sought approvals. So those have been some of the trends that we are seeing in the adjudication space. Over to you, Rohinton.
Thanks very much, Neha and Hema. We actually are about 3 minutes to our end, and we've actually received a lot of questions at the back end, mostly around 10F filings and the angel tax. We have also a question on EQL, which I picked up, which I thought was interesting. The question, Hema, I'm going to direct it to you. It is, what is the basis for cross charge of HR services by a non-resident headquarter to be subject to equalization levy?
Okay. So if a headquarter is providing HR services to multiple group companies, and this HR services are provided via some sort of a platform or an online basis, then the applicability of equalization levy in that scenario will need to be examined because service provision could be an online.
Thanks, Hema, for that. Another quick question for you, Hema. When you say the 10F has to be filed online, does that mean by email to the customer, or the seller must send direct to the tax office for each transaction? So again, a question on 10F. Lots of them actually in the chat. Hema, if you're speaking, you're on mute.
I'm so sorry. So online filing means there's a income tax account of a non-resident. You are required to submit the Form 10F along with the tax residency certificate in your income tax account on the income tax portal. And once this is submitted on the income tax portal, a copy of that can be provided to the multiple payers. So it's on income tax
Thanks,
portal, not
Hema.
via email, etc.
Thanks, Hema, for clarifying that. That unfortunately is all that we have time for. Neha and Hema, thank you, and special thanks to all of you who were able to join us. We would like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you thought about today's program. If you did join us late, please note that this presentation will be archived for future viewing. And if you feel others would benefit from this webcast, please share the webcast via the share this icon or have them visit our debriefs website. We will respond to all questions submitted during the webcast in a couple of weeks. Also, if you think of any other questions or comments later, please feel free to reach out either to me or our speakers, and we'd be more than happy to talk to you. And please don't forget to tune in to our next scheduled webcast from the Corporate Income Tax series on the 10th of August, titled Australia Tax Updates. At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.